Good afternoon and welcome to this week's Market Matters weekly video update. I'm Harry Watt. This is James Gerrish. We're going to talk some stock-specific stuff today, James. A bit of a change of tune from recent videos we've had together. So we're going to fire off four different stocks and areas of the market that we're looking at the moment we found interesting. First thing we're going to kick off with is Paladin, which is a uranium name we've held in our emerging companies portfolio. They've announced the restart of the Langer Heinrich mine. We spoke to them yesterday, James. What was your takeaway from speaking to management?
Yeah, you're right. We've held Paladin. We've been in and out of that stock in the emerging companies portfolio. Overall, we've done well out of it. They came out yesterday and confirmed that they're going to start the Langer Heinrich mine in Namibia. We thought that was going to be the case. They've raised money to fund that development. We had Ian Purdy in to talk about that. So, we're bullish uranium. We've written about it. We're bullish the energy space, largely around this big movement towards cleaner energy, and we think uranium is going to be a key part of that. In terms of the mine itself and the development of that mine, they came out yesterday, and the market was a little bit muted when they came out yesterday because costs were higher than where they were 3 months ago. So 3 months ago, they said it was going to cost them $87 million US to get this mine up and producing. Now it's going to cost them about 118 million. There's a few additional costs in there that they're bringing forward, but overall it's a good update. It's as expected. Spot uranium prices are around the mid 40s. We're hearing contract prices more closer to the mid 50s, which is important for Paladin. So overall, we like it. It's in the emerging companies portfolio. We think it's going to have a really good 6 to 12 months on the back of strength in uranium.
We're going to stick with energy markets, but just quickly on that one, we have heard Japan, a lot of energy companies in Japan are trying to secure more uranium supply. So there is definitely some demand coming out of the woodwork in that space. Kicking off with Whitehaven as well, another one in a similar sort of space, one we've also done well out of.
Could have done better. Could have
done better. They had their quarterly production numbers out yesterday and some staggering numbers, James. We've seen it run pretty hard. 18 months ago, you turn the clock back. No one, you couldn't give stock away on Whitehaven, and now everyone seems to be loving it. I guess, what does that mean for Whitehaven going forward?
Yeah, so, I sit back and look at FY21 and we had a really great position in Whitehaven. We bought it at an average price in the $50s. We subsequently sold it just above the $4 mark. So, great trade on paper, but now Whitehaven coal has continued higher. It's trading around $6 at the moment. You're right. I was looking at the earnings expectations for this year. They're going to produce earnings per share of about $1.50. So think about that. That's what we paid for the stock initially. We wrote the other day that they're producing as much cash in the quarter as NAB did, which is Whitehaven's capped at $5 billion or thereabouts. NAB's a $90 billion Goliath. So clearly coal markets are really strong at the moment. They're producing at the right time. They have had a number of production issues in the past that they've rectified and all of those things. So the momentum is really strong. Every broker that I read is now super bullish on Whitehaven. We see Rocky, who we've spoken to on videos for Market Matters a number of times. He's pretty barred up over this stock in our morning meetings. I'm a little bit more not concerned, but I think the market is now wholeheartedly bullish on it. So we wrote about potentially buying it again. I'm more inclined to probably buy the next pullback in Whitehaven as opposed to buy new highs. So, we might miss out on it altogether, but we're prepared to do that. From a risk-reward point of view, I think you've got to be buying pullbacks as opposed to new highs in Whitehaven. But in saying that, the numbers are simply phenomenal. But it is a commodity company, so things can change. And I don't think China's going to put up with coal prices where they are for an extended period.
All right. Last week we sat here 6-7 days ago and we talked about unemployment and that effect on retailers. JB Hi-Fi was out with an update earlier this week, and they was also some great numbers, well ahead of the market, but it was only really up 2% yesterday. Once again, quite a muted move, like Paladin's good announcement yesterday, I guess, as well. Is this, are we seeing sort of the best times of retailers sort of gone and past, or is this going to be lasting for another 6 or so months?
Well, it's hard to know, but I think where the market's positioned for more pain to come. So, the market took JB's numbers yesterday and said, it's above where we're expecting them to be. That's great, but the outlook for the next 6 to 12 months is more challenging with higher rates and concern around discretionary spending and the like. I think to me, and markets are all about positioning and how overly optimistic or overly pessimistic investors get. It was interesting last night. The Bank of America Merrill Lynch investor survey came out, and investors are the most bearish they've been around risk. I think that's important when we think about retailers, because I think all I hear about is negative consumer discretionary stocks. Every fund manager monthly that comes out is all stay away from consumer discretionary stocks. To me, that probably signals a low. So yeah, I'm more positive on it than the market is, and we saw that play out in the numbers from JB Hi-Fi yesterday. We don't have any consumer discretionary stocks in our flagship growth portfolio. We've got a couple in our income. We've got one in our income portfolio, and we've also got one in our emerging companies. Lavisa. Sorry, I'm getting mixed up there, Harry. We've got Lavisa and we've got Wesfarmers as well, and to a lesser degree Metcash, which is some of their exposure as discretionary retail. So look, I'm not negative the space like the market is, so I think there's probably more surprises like JB Hi-Fi to come.
Like Dusk today as well. That was a big one.
Huge one. I mean, they're numbers. So when valuations are depressed, the market hates them, and they come out and deliver reasonable numbers, they're going to bounce. So don't get too negative on consumer discretion like everyone else is, would be my clear message.
Netflix comments last night has come to mind as well.
Well, they lost 970,000 subscribers. The market was expecting 2 million loss. When companies get their back against the wall, the good ones rejuvenate themselves and stem losses and right the ship, if you like. JB Hi-Fi is a great company. They've done that. Netflix has got a great management team, and they're clearly doing that at the moment.
Speaking of backs against the wall, fund managers, they've been beaten up for a long time. We own a couple of them. We own Pendle, which it looks like Perpetual is going to have another lunge at soon. That we had some brief news on that one yesterday. We also own Pinnacle in the space as well. Fund managers going forward, they are sort of leveraged the market. We've seen the market bounce today, and a couple of them go with them. We're going to see this sort of play out for a little while now.
So you think about, is the headwind for a company or a sector cyclical or structural? So that's the thing that everyone's grappling with in fund management land at the moment. Is this our active managers and the old school fund managers, is that model broken because of ETFs and the like? I probably don't think it is, and I think active management has a clear place, and the more people move down towards the passive area, the more opportunities active managers will have. So, Pendle trades on 8 times earnings. It is being looked at by Perpetual, which trades on 12 times. So you think about using more expensive script to buy cheaper script. Makes sense to us. We've got Pendle because we exited Magellan for a loss in our income portfolio during the year. We think Pendle's got more upside because of this Perpetual interest in it. That's now playing out, so fingers crossed we get a decent premium from Perpetual for Pendle, and we can make some of those losses that we made in Magellan up. To your point about Pinnacle, I mean, this is a stock that was trading nearly $20 and it's trading at $8.80, I think, at last look. It's still on 20 times, but it's got a really interesting business model. So that's why we've got it in, you've got it in your emerging companies portfolio. I think it's a buy here to me. I think Pendle's a buy. That's why we've added it. So the sector's cheap, and I think there's better times to come for it in the next few months.
All right, that's all we got time for today. Hope you enjoyed. Hope you got something out of it. We're 3 weeks into FY23. We've got a big year ahead for Market Matters. A couple of big announcements coming up in the next few weeks to look out for. So I hope our subscribers enjoyed that, and have a great day.